Welcome back. We're at lesson 8 of the Put Path 101, trading with diversified underlings. So in this lesson, we're going to get into the real meat of the Put Path options trading system. This is really the kickoff. After the last couple of lessons, they were kind of boring. There's really nothing new that you haven't probably already known that went into those. But this is where we start. This is really how we differentiate the put path from other options trading frameworks. So I'm excited. Hopefully you're excited. So sit back, relax, get ready to learn, and let's get going. Remember the acronym UDS. You probably heard of Uggs. Well, this is UDS. So what does UDS stand for? The U is for underlings, D is for delta, D is for DTE, S is for spread width, and S is for size of your positions. So we're going to start with underlings, probably the most important place to start. You've got to understand what you're trading. There's some key elements of underlings that we're going to review, and these make it the best 12 vehicles for us to trade. We're going to go over all 12 in detail. We're going to talk about the benefits of these 12. We have 6 stock-based ETFs, and then we have 6 alternative assets that we trade. And that provides us with the diversification that we need in trying to protect ourselves from a sharp market downturn. What is an ETF? So my apologies if this is kind of basic and you already know all this information, but I would like to remind you this is a beginner course, so I'm going to go over some definitions and some things that may be pretty basic. So an ETF is an exchange traded fund that holds multiple assets. The majority of those are stock-based funds. However, we do have some ETFs that we trade that are bond-based funds like TLT and real estate-based funds like IYR. So the advantages to an ETF is that it holds multiple assets. The S&P 500 holds, you guessed it, around 500 assets. And those provide built-in diversification because sometimes those stocks go up, sometimes they go down. Additionally, these ETFs trade like stocks themselves, so they can be bought and sold on the exchanges. The ETFs that we have are highly liquid, so that they have markets out there that are narrow and that provide us with the trading volumes that we look for. So why do we trade mostly ETFs? It's because of all the benefits. So when you look at ETFs, they have these built-in diversification where you have some stocks within that ETF that are going up. Let's say Apple and Tesla have great days and they go up, but Bed Bath & Beyond doesn't have such a great day and it goes down. That is going to offset each other slightly. So you have that built-in diversification, and it allows you to capture an asset that trades hundreds of underlying assets. So you have that built-in diversification. We also make sure that these ETFs have liquidity. So there's some ETFs out there that we have deliberately chosen not to trade because they don't give us the trading volume that we need, or they don't have weekly options. And we're going to talk about some of the exclusions in a later slide. But we wanted just to make sure you understand these are highly liquid, the markets are good, and they're going to minimize your single stock risk. So when we have these single stocks, those are exposed to binary events, meaning something is going to be like a light switch, either on or off. The stock could either move very quickly up or very quickly down based on things like lawsuits, based on earnings reports, based on analyst downgrades. So those are called binary events, and we're trying to avoid those where possible. Here's a little bit more on ETFs. So again, we're looking for liquidity. We're looking for something that is bought and sold a lot. There's a high trading volume on the market. So the bid-ask spread is what we look for. A narrow spread indicates better trading conditions. So the bid is the highest price that the buyer is willing to buy at. The ask is the lowest price that the seller is willing to sell at. When those two come together, you have a trade. That's the whole basis of the stock market. So we look for that to be as narrow as possible. That means you have a lot of players in the market and they're all trying to exchange the underlying. Diversification, again, if you have 30 things, 100 things, 500 things, 2,000 things in your basket, you're in better shape. You've always heard, don't put all your eggs in one basket. So these are the eggs. These are the things that we want a lot of that provide that built-in diversification. And again, we're looking for weekly options. So the weeklies are what we use so that we can carry out our laddering concept where we have one coming on and one falling off for each underlying each week. So we got to make sure that that's there. Now, why do investors in general like these assets? It's because of that diversification. It's because you can buy a slice of every major large company in the United States with one trading vehicle, like the S&P 500, either the SPY or the SPX, which we trade both of. So that's why investors are there. That's why the ETF exists. And that's why we trade these. Is there something magical about these underlyings? No. But I can tell you that I've been refining this system since 2020, and I've learned a whole lot about what works and what doesn't work. So I've tried trading individual stocks. I've tried trading low liquidity products. I've tried monthly options. I've tried leaps. I've tried everything that you can imagine. And what I've realized is within the put path system, these 12 underlyings work really, really well. So the stock-based underlyings that you can see here are some of the biggest names in the world. We've got the QQQ, which is the NASDAQ. We've got IWM, which is the Russell 2000, SPY, which is the S&P 500, DIA, the Dow Jones. And then we have two specialty-based ETFs. So these are SMH, which is your semiconductor-based stock-based underlyings, and your XBI, which is your biotech stocks. We're going to get into all those. Our first underlying that we recommend is QQQ. So QQQ is the NASDAQ 100. So the NASDAQ is an electronic stock exchange, and the NASDAQ 100 is the top non-financial stocks within that exchange. So QQQ tracks the NASDAQ 100, and NDX is the actual index of those 100. So some stocks that you have definitely heard of are in this index, things like Apple, Microsoft, Tesla, and others. It's got a high trading volume. It is the entry point that we recommend for beginning options traders because of that liquidity, because of the tight bid-ask spreads, and the volume is so huge. And investors also flock to QQQ. It's got strong historical growth, and it's going to be around for a long time. These are the growth companies. These are the tech companies. These are providing the growth engine of America's economy. The next one that we recommend is IWM, and I'm doing these in order for a reason. So IWM is less correlated to QQQ than SPY is. IWM is approximately 75% correlated to QQQ. So when we think about some built-in diversification, and if you're only going to trade a certain number of names, some people may not be able to trade all 12. I would start with QQQ and then move into a non-stock-based underlying. But for the next stock-based underlying, I'd go back to IWM. So IWM is the Russell 2000. These are small cap stocks. This is 2,000 that are smaller in size, and they represent a large swath of the American economy. Some things like Fluor and some smaller companies that represent the heartland of America, farming, oil, some smaller retail shops like Sprouts, stores that are specialty, Abercrombie and Fitch, stuff like that. So the reason that we get into IWM is to provide that different perspective. It's not high tech. This is going to be more smaller, a broad economy based US stocks that's going to provide a little bit of diversification. And that's what we look for. And that's why we have it second on our list. Now, SPY is third on our list. So, how can you be saying that SPY and SPX is third? People love to trade SPY, SPX. Well, in my view, QQQ is a better trading vehicle to start with, and it actually gives us about a 50-cent credit versus SPY, where we're getting in the 40 to 45-cent range for the same width of spread. So I like starting with QQQ. If you like SPY better, then by all means you can start there. But what the SPY is it's the S&P 500. It's the biggest stocks in the United States. It's the index that is the most popular. It is market weighted, which means that the bigger companies, they have a bigger percentage of that pie and they have more influence on the price, and it provides diversification. So it grows across all market sectors. So it's not focused on technology, for example. It's not focused specifically on biotech. It's not focused specifically on semiconductors. This is the whole US economy, the largest 500 companies. Additionally, I should mention that the SPY and QQQ have a very high positive correlation, around 90% correlation. So what that means is they almost always move in the same direction.
Let's look at DIA. So DIA is the Dow Jones Industrial Average. It's the granddaddy of them all. It is the boomer index. It's been around since the late 1800s, highly used in the mid to late 1900s as the bellwether of the American stock market. It is the 30 biggest names in large cap stocks, and it has slightly wider bid-ask spreads than we're looking for typically. However, it is a good trading vehicle. We typically try to get around 41, 42 cents each week off of DIA, and it does provide important diversification benefits against QQQ, for an example. So many times I find that DIA and IWM tend to go down when SPY and QQQ go up. So there is some uncorrelation diversification benefit when we trade DIA. Let's take a look at SMH. So SMH is our semiconductor ETF. This one is highly liquid, and with the AI boom, it is being traded at amazing volumes, and it has a lot of volatility, and it has a lot of action day to day. The bid-ask spreads are very tight, and we get really good pricing. We get really good strike prices that are far away from the current stock price. It is a highly tradable ETF. The semiconductors are highly related with the AI boom, and there's a lot of boom and bust associated with SMH, but it is a great trading vehicle, obviously highly correlated to the tech sector and QQQ. So it is one of the leading indicators of the economy and the tech sector and the AI development and innovations associated with that technology. XBI is the next sector ETF on our list. So this is the biotech related sector, and this has got a lot of growth companies that are doing some drug development, and there are also bigger companies like Thermo Fisher Scientific that are into the healthcare sector. So you've got some exposure in technology you've got exposure to healthcare. And I just want to reiterate, these stocks, we're not choosing these ETFs because of a bullish position necessarily. We're choosing them because they have high liquidity, because they trade as investment vehicles for options really well. And what we've seen with XBI is it does have a lot of volatility, and it has a opportunity for us to trade our weekly options, and it is highly liquid and is exactly what we're looking for. I wanted to take a minute here and explain why we have alternative underlings. So we have 6 of these, and the rationale behind this is that if all 6 of our stock-based underlings go down, we have some alternatives that will buffer against that market move down. When there is a recession, when there's a black swan event, all 6 of those stock-based underlings are going to go down. There's nothing that we can diversify out of. There's nothing that we can plan for. We will probably lose on all 6 if the strong enough move downside occurs, like a black swan event. So the intent here is to buffer against that, to have an equal number of names that we can use for the other side to hold the line, if you will. So these are alternatives to stocks. We've got 3 that are single asset commodity names. So there is some risk there because they're single assets. So we've got gold, IBIT, and USO. We have 2 that are ETFs, which is IYR and TLT. Those are ETFs, so they're made up of multiple assets as underlings, which is really what we look for. And then we've got the VIX. So the VIX is the counter side to all of the stocks that we've got going in the whole stock market. So what I mean by counter side is it's the fear of those stocks going down over the next 30 days. It looks across the whole spectrum of the market and determines what the market sees as volatility for the next 30 days. So as the VIX goes up, stocks will go down and vice versa. So why do we choose gold? So GLD, the gold ETF, is a single asset commodity based trading vehicle. It is highly liquid. It's very tradable for options traders. It provides diversification as it is a hedge against stock market volatility. So a lot of people flee to safety when stocks start to go down, which can push the price of gold up. But it is an independent asset for the most part. It's not correlated to the stock market, which we like. And that provides that correlation diversification because it is uncorrelated largely to the stock market. It is stable, particularly in terms of a market downturn, black swan event, potentially even. However, what we don't like about gold is it is a single asset exposure. So we only have obviously one commodity that it's representing. So when the price of gold goes down, you can feel the losses pretty quickly. Now, gold is interesting because it actually has a little bit of call skew, and we'll get into that in some of the later lessons. And we have typically put skew for our stock-based underlings. IBIT is our second alternative asset. And again, we're doing these in order. So gold would be your first one that you want to start trading. IBIT's going to be your second. The reason that we use IBIT is because it is very liquid. It's got a lot of market interest. It is the Bitcoin cryptocurrency tracker, and it moves along with the price of Bitcoin. It is regulated, and it's an ETF that tracks the price of Bitcoin. So it's kind of new in terms of all of the 12 that we trade. This is the newest emerging asset class, if you will. Bitcoin is highly volatile. and you get really good pricing on IBIT so that you get your strike prices far away from the current stock price or underlying price. So that is very good for us. When we're trading that 15 delta, we're usually far, far out of the money, and we get really good win rates with IBIT, and we include it because it is, again, providing that diversification. It is not linked to the stock market. Some people say there is some correlation between QQQ and IBIT. I don't know that that's really been proven. I think IBIT is so new that it kind of does its own thing. And in terms of the diversification benefit of that and the uncorrelation, we really like that as a trading vehicle. So USO is number 3, and we really like USO as a trading product. It has very tight bid-ask spreads. It's got a high liquidity. Obviously, what this is a direct exposure to the oil markets, and it is linked to oil price movements. Now, this can be highly volatile. In 2026, when I'm recording this video, we've had a war in Iran, which pushed the prices way up and then pushed them way back down. So we've had quite a losing year in ISO. Would need to do the calculations. I'm not sure if we've actually been net positive with USO for the year, but it has had a lot more losses for sure, and the win rate has gone down. But in a normal year, when it's a little bit more stable without world conflicts, this is a very tradable, highly profitable underlying. It is uncorrelated generally with the broader stock market. In fact, many times when the price of oil goes up, the stock market will go down. So there is, again, uncorrelation benefits with USO, and it is giving us that underlying that is outside of the traditional equities. The problem with USO is that it is a single stock or single underlying asset, and it is highly dependent on world events, and you can have some losses if there are shocks to the system. IYR is number 4. I really like IYR in terms of what it offers for a different asset class, a different sector. It is real estate based. It's an ETF, so both of those are really good things. You know, real estate is largely independent of the stock market, even though there are some interdependencies in commercial real estate sector. However, what we really like about IYR is that it does have stability in terms of dividend payments to the underlyings that make up the IYR. There is a lot of price stability in that regard. The diversification, outside of traditional equities is excellent. The problems with IYR, and it can be a little bit disheartening, is it's got wider bid-ask spreads than we would want to see. The liquidity is not great. It is the worst liquidity of all 12 of these underlyings. However, it does allow us to trade. You just have to sometimes put in multiple orders for that week, and you're not going to get the pricing necessarily as you would with some of the other stock-based underlyings. We're typically only looking for about 25 cents or so per week out of IYR, but we still include it because of all the other benefits. TLT is much more tradable. TLT is the bond ETF. So this has got a huge market. The bond market eclipses the stock market by 10 to 1. The liquidity in TLT is very good, although the pricing is not. You're going to get about 25 cents per week per contract out of TLT. However, the benefits are outstanding. We have a negative correlation with the stock market, meaning that as the stock market goes down, TLT will normally go up and vice versa. The bond market provides a completely different asset class to get into, so that is going to provide buffering from the stock-based underlyings again. So it's going to counterbalance that equity exposure. It's going to provide protection in times of trouble, and we really like TLT in terms of all of the benefits that it offers. Okay, the VIX. The VIX does its own thing. The VIX is a special animal. That's why it's number 12. You really need to understand options trading before you add the VIX to your portfolio. I think this is one that it takes a little bit of experience to understand what's going on, and we put it as number 12. So what is the VIX? So the VIX is the fear gauge of the market. The VIX is going to go down when things are calm, and it'll go up when stock markets start to have fear. And what this is a gauge of all the stocks
in the S&P 500
and what they see in terms of volatility 30 days out. So the VIX is a measure of a conglomeration of all of those underlying stock volatility measures. So it's going to measure market sentiment. It's going to tell you how fearful that the market is. So again, as the market fear goes up, the VIX is going to go up. This is a great trading vehicle. It allows us to hedge against market downturns. So when we have stock markets that go way down, the VIX is going to go up, which means our positions will win. So there could be doomsday scenarios where we've got, 11 of these underlings that will go down and the VIX is going to go up. So you know for sure that you're going to have a winner. The VIX is, again, for advanced traders, and just want to reiterate, it does its own thing in terms of how we trade it. We sometimes will trade the VIX in the money, which is something that we don't do with any of the other 11. The VIX also expires on Wednesdays, so that is a difference. You're going to have to make sure that you're closing your positions out on Tuesday because of the AM closure on the VIX. So there's a lot of specialty things about the VIX that we're going to have to talk through, but the VIX is essential. If you learn how to trade it, the VIX is your friend. So what do I mean by ETF and alternative rotation? So what I'm saying here is that if you start out with a smaller account, let's say you start out with $2,000 and you're trying to scale up to that $24,000 that you need in order to trade the whole system on a laddering basis for one lots in, one each week. So as you're scaling up from 2,000 to 24,000 in your account, you're going to need to select different underlings. So we put these in order from 1 to 12 to tell you which ones to start with and which ones to finish with in that 12. So the QQQ is the one that you start with, and then the VIX is going to be the one that you end with. And what we say is that you want to rotate between the stock-based underlings and the alternative underlings. And why would you do that? You do that for the uncorrelation benefits. So if I'm trading QQQ and GLD, that would be the order that we go in, right? QQQ, GLD. So that's going to provide you with some of those uncorrelation benefits. The different trading vehicles are going to allow you to have more consistent returns. So the spread risk across these different types of asset classes and markets and sectors is going to allow you to reduce your portfolio risk. So we're going to talk through exactly what that means in a couple of lessons here. So the different types of diversification that we're looking to diversify across sectors is one of the main reasons that we have these 12. So the different sectors that we're talking about the standard stock market, your SPY, but then we're talking about some specialty ETFs like biotech and semiconductors. And then we're talking about commodities where we've got gold, Bitcoin, oil, which are all three different types of assets. And then we're talking about real estate, which is a whole different asset class. And then bonds, different asset class. And then volatility that provides that negative correlation. So the differing asset classes are going to protect you against a sharp stock market down move. And we're trying to buffer against that as much as we can to prepare and protect our account. So we're mixing investments strategically. And what that's going to do is it's going to optimize your trading so that you're looking at 12 different underlings. So we could theoretically have a 12 lot of QQQ. Now, we don't want to do that. We want to put a one lot of QQQ, a one lot of GLD, a one lot of IWM, and then go through the whole list. And what that does is it diversifies the underlying names that you're trading, and that's going to allow you to have some protection. It's also going to allow you to utilize the law of large numbers easier, and you'll be able to have more trades and more opportunities to increase your win rate, and you won't be concentrated in one asset. So philosophically, what variables do we use when we selected these 12? One of the major variables is liquidity. Now, you don't have to trade the 12 that we trade. You may want to do your own system, your own thing. However, I recommend these 12. These are battle tested. These are proven over years and years and years. And the way that the system integrates and provides protection, I think, is really key. But I do want to say why we chose these. So we chose these based on liquidity and some other factors and variables. The liquidity is so important because you have to have tight bid-ask spreads in order to get the best pricing. It's going to improve your fill pricing, and it's going to allow you to have quicker fills so you don't have to spend all day trying to trade these different underlyings. Also, we're going to get into the weekly options availability. Typically, the more liquid, high market interest names are the ones that are going to have that weekly option availability, which is key to the system. You can't trade without it in order to use the laddering technique that we use. And then market efficiency. So again, faster executions. You have to be able to close these trades out if you get into a pinch, and you have to be able to avoid a roach motel for an underlying where you can get into the trade but you can't get out. These underlyings provide a system. They provide an overall risk mitigation approach. That's why we have the 12, because we are trying to protect ourselves when the next storm comes, when the next black swan event, when the next recession hits, when the next unexpected event occurs in the market. We need to be ready. So these 12 are going to provide us with diversification. We've talked a lot about that. Also, when we have a volatility spike, we have some of our assets that are going to be able to buffer against that volatility spike. And obviously, we're looking for underlyings that can trade weekly. So we're looking for liquidity. We're looking for a system that uses all of these assets. Again, I want to make sure that you understand bid-ask spreads. So we're talking about bid-ask spreads. That means that you have two parties to the transaction. So the bid is the buyer. Remember, B and B. So the bid is the max that a buyer is going to be willing to pay for a particular asset, in this case, an option. And then the ask is going to be the minimum price that the seller is going to be willing to accept. So where those cross over is where you have an agreement and where you have a transaction. So how does this affect us? We need to make sure that we have the appropriate amount of buyers and sellers, that we have the ability to get in and get out of these positions so that we are not trapped, and so that we can trade quickly and get the best pricing. So, we're going to get better fills, which is going to improve our profit potential. This is really just a summary chart. So when we talk about the put path options trading system, we're talking about a strategy that's going to integrate these 12 underlyings. And the reason why we chose them are what you see here is diversification, liquidity benefits, the different asset classes, and the risk management buffering against sharp market down moves. We recommend that you start with QQQ. and then you build up all the way to the VIX in that order. The reason why is because we're going to select that stock-based underlying with an alternative asset underlying, and then we're going to start with the, quote, best stock-based underlying, which is QQQ. Then we go into IWM, SPY, DIA, SMH, and XBI in that order. And then alternatively, we're going to choose gold, IBIT, USO, IYR, TLT, and VIX. So we do that very specifically because we're trying to make sure that you're going to get the different benefits that we talked about with the different asset classes and the different types of trading vehicles. So it's going to limit your exposure to a single market movement. And why do we choose QQQ? Again, it's going to give us probably about 50 cents a week, and it is highly liquid. A lot of people are in the NASDAQ 100, and it's a very strong trading vehicle. It's going to have action on both sides always. And QQQ and the index itself, NDX, is what we trade. So that's the one that we start with. So here's the reason that we exclude some underlyings from our 12. Obviously, you've got to have the weekly options. There are a lot of names out there that only do monthlies still, so we don't allow those. Any underlying prices that are really far out of the range that we're looking for. So typically the names that we look for are between $50 and $750. So once you get under 50, it is really hard to get $5 wide spreads. And once you get over 750, $5 wide spreads are not enough. So you're going to have to expand to $10 to $25 to $100. So that's really the sweet range, the 50 to 750. So some of the other exclusion criteria we exclude based on really wide bid-ask spreads. So if you have a dollar wide bid-ask spread, that's really not going to help us. It needs to be down to a penny, 2 pennies, 3 pennies. That's really what we're looking for. And then there's some other assets that were single asset or stock or commodity names that we excluded. We really don't like the single asset risk. However, with GLD and with IBIT and with USO, we have allowed them into the system because they do provide such a correlation diversification benefit. So some other names that we exclude were because they didn't have any diversification. So why are there 12 names? Why not 10? Why not 14? Why not 20? Well, we settled on 12 because they meet all of our criteria. We settled on 12 because they help us to get that number rate up in terms of number of transactions each week. And they're going to allow those benefits to occur. Each of them has a specific benefit into the put path options trading system in terms of how it performs as a whole. So what we're looking for across all 12 is that 85% win rate, and we're looking to be able to have the diversification, to have a system that allows us to get a lot of trades on. We could go with just QQQ and GLD and just trade those. However, it's going to be less than optimal. You're going to have less trades. You're going to have more risk. So we want to get the number of underlyings up to a level as high as possible while also meeting all of the criteria that are required. And we haven't been able to really add any additional underlyings over the last few years because of the restrictions, the exclusion criteria that we go through. So this is the 12. I think this is a strong system. We are always modifying. We're always looking for better opportunities. But for now, the 12 that we're using are very solid, and they provide that income generation weekly that we're looking for. So when I was developing the system, really between 2020 and 2022 and somewhat into 2023, there was a lot of underlyings that we had to exclude. And, the majority of that is insufficient trading volume, lack of weekly options, and low volumes, low investor engagement, wide markets, wide bid-ask spreads. So we really could not include a lot of those. And then the pricing, in terms of the range of underlying pricing that we're looking for, around 50 to 750. So this is the last slide. This is a summary of our takeaways. This really is the kickoff to the put path options trading system. This is where it gets fun. This is where it gets interesting. Hopefully you're excited. I know that I'm excited. This is really where we start to differentiate the system into something that is, I believe, really special. It's going to be able to provide you with consistent income generation, only 15 minutes per week, and it's very consistent over time. So here's some of the things that we look for in terms of these 12 underlyings and why they're part of the system. So I think they're going to provide you with the optimal risk-reward ratio in terms of being able to get you high enough premium for the risk that we're putting on with the $5 wide spreads. They've all got the necessary liquidity with the tight bid-ask spreads. Some of them are much more liquid than others, but they all are good enough trading vehicles at the end of the day. IYR, we really don't like the liquidity in, but it does have a good enough liquidity. So the vast majority of the other ones have great liquidity. So we really like those. They all are able to trade weekly options. They're going to have the ideal width that we look for with the $5 spread. We look for the uncorrelation benefits. They're going to provide diversification, and they're going to give us the necessary exposure against a broad market downturn. They're going to provide that protection. So a lot of benefits to using all 12. We have a huge amount of data. We have over 1,000 trades over the last 6 years to back up why these are really going to be able to provide you with that consistent income over time. So this is the first step on how do we do the setup, how do we do the selection, and I really think that this is going to be interesting for you to learn, for us to learn together, and to continue to communicate and get started with the put path options trading system.